Welcome back to the HECMWorld Weekly Podcast, where we bring you the latest reverse mortgage news from across the nation. Now, our first story is going to look at working longer. Now, it's been said it's one of the best ways to ensure one doesn't outlive their retirement savings, but the problem is you can't always count on that as a strategy. In other words, reality often intrudes on our best laid plans. Now, when it comes to retirement age, there's a big gap in expectation versus reality. Americans generally retire earlier than they plan to, often due to factors beyond their control, such as poor health, a job loss, or other factors, according to research. In 2022, the average expected retirement age was 66, the expected, that according to the Gallup poll. But the actual retirement age was 62 on average. Now, while those averages have varied somewhat over the years, there has been a consistent gap of about 5 years between the expected and actual retirement age, according to the Gallup polls, and that's been since 2002. So almost half, or 46% of American retirees, said they left the workforce sooner than they had anticipated, that according to the Employee Benefit Research Institute's 2023 Retirement Confidence Survey. And that percentage, by the way, has been similar for over 2 decades. It's been hovering somewhere between 40 and 50%. I think a lot of people who are not on track for retirement, maybe they're in their late 40s or early 50s, say, I want to retire at 65, but I'll work to 70, said David Blanchette. He's a certified financial planner and head of retirement research at PGIM, and that's the asset management arm of Prudential Financial. But they probably won't make it to 70. Now, that is true. Blanchette is looking at the unexpected realities that retirees face. Now, delaying retirement for just a few years can have a dramatic positive financial effect, says Blanchette, but such people do continue to get a regular paycheck and they're not having to live off their savings, so they're not tapping that retirement nest egg. Meanwhile, they have extra time to save for their assets to hopefully grow. Now, they can likely delay claiming their Social Security benefits as well, and that would guarantee them a higher monthly payout for the rest of their lives if they live long enough to collect it. But retiring earlier than anticipated can have the opposite impact. Less time to save, and you're going to have a shorter period for sustainable withdrawals. So largely, this disproportionately affects people who plan to retire in their early 60s or later, that according to Blanchette's research. And ironically, that happens to be the age at which one may qualify for the federally insured reverse mortgage, or HECM, as the minimum age of 62. Now, those who target a retirement age past 61, they end up making it about half as far as they expect. For example, someone who aims to retire at 69 would probably retire around age 65, yet countervailing trends are pushing workers to retire later. Inflation is probably one of them. And 1/3 of workers expect to retire at age 70 or later, or not at all, according to EBRI. But only 6% said they did retire at 70. Now, Social Security's full retirement age has been pushed back gradually as late as age 67 for anyone born in 1960 or later. And Americans are living longer due to medical advances, and that means they need to amass more savings to fund their lifestyle in old age. Now, today's strong labor market means that it may be easier for older workers to actually find a new job or to keep one. However, it's unclear just how long that strong labor market will last if we're heading into a recession. It also may be easier than many retirees today, especially those who can work from home. They can find a part-time gig job or to help blunt the financial impact of earlier than expected retirement from full-time employment, and that's always an option. This story I found down under, and it's quite interesting because here in the U.S., our industry is struggling to gain market penetration. We remain challenged for that acceptance, but Australians, they're flocking to the reverse mortgage program, that according to a recent column in the Sydney Morning Herald. The number of participants in the Australian government's reverse mortgage scheme today is growing at an annual rate of about 60%, as more Australians seek to unlock the value of their homes to help boost their income, as they call it, in retirement. We wish we had the same here. Figures from the Department of Social Services in Australia show that there are approximately 9,750 participants in what they call the Home Equity Access Scheme in June of 2023, and compared to 6,041 in June of 2022. So there's your growth rate of 60%. And the total value of the money that has been drawn under the reverse mortgage scheme by participants was $240 million in June of this year, and that's up from $138 million from the previous year. Now that's just a drop in the bucket relative to the amount of equity that's locked up in older Australians' homes. However, if the reverse mortgage scheme does continue to attract participants at the present rate, it's going to become a very significant feature of the retirement landscape. I'm going to tell you in a minute why that's going to even become more so. Now, the reverse mortgage allows those in Australia who have reached the age of pension or are partnered with someone who has to receive an income stream or a lump sum payment where the family home or an investment property is put up as collateral. So it doesn't seem it has to be the primary residence. Now, the debt on the reverse mortgage scheme builds as payments are made to the borrower, and no repayments on the debt are made. And the interest is capitalized and debt builds relatively quickly. However, the reverse mortgage scheme down under is conservatively managed, with the loan balance only being allowed to grow to a ceiling that is just a fraction of the value of the home and other factors. It'd be interesting to see an illustration on that. So when the house is sold, the loan is going to be repaid through the proceeds, or though the debt can be repaid at any time. Now, the eligibility of the Australian reverse mortgage scheme, the government program, was expanded in July 2019 to almost anyone over the pension age, whether they're receiving the pension at the full rate, part pension, or they're being fully self-funded. Now, a further change to the reverse mortgage scheme down under came into effect in July of 2022, and that allows participants to access lump sum advances rather than just getting an income stream subject to caps. So there's a little more flexibility. In fact, a couple on the full age pension could receive a boost to their fortnightly, and that's biweekly by the way, pension of up to 50%. And the payments are not accessible under the age pension means test. With interest compounding fortnightly at 3.95% per annum, the government's offering is a far cheaper than a traditional reverse mortgage, said Effie Zahos, Censar's editor at large. Now, there's one reason why they might be gaining popularity of the reverse mortgage scheme in Australia, and it's that in January 2023, the Australian Securities and Investments Commission, that would be like our SEC here, confirmed that financial planners can advise on the home equity access scheme without the need to hold a credit or mortgage license, which will likely increase interest in the reverse mortgage even more. And in our final story of the week, the Federal Housing Administration, or FHA, has published their consolidated and comprehensive policies for the HECM, the Home Equity Conversion Mortgage Program. Perhaps you've heard rumors that would be happening, and it's going to be the inclusion of those policies in what is known as the Single Family Housing Policy Handbook, version 4000-1. Now, for the first time ever, all HECM program requirements are going to be available in just one single guide or handbook, and that's good news. Now, the mortgage report says that that publication is going to eliminate more than 100 individual policy documents that have been associated with the HECM program over the years. And this consolidation into a single handbook is going to help strengthen the understanding and also the implementation and administration of the program by lenders, servicers, and that will enhance one's ability to actively engage with more than 60,000 senior homeowners who are choosing to obtain a reverse mortgage or a federally insured reverse mortgage to help age in place. Home equity conversion mortgages are one of the strongest tools that we have to ensure thousands of seniors can age in place, said HUD Secretary Marcia L. Fudge. This new guidance will give people one single place to easily access the information needed to obtain and maintain a HECM. And that last part is very important, how to maintain it. Now, with the incorporation of the new HECM sections into the Single Family Handbook, FHA has completed their multi-year effort. It's taken several years to deliver a consolidated, comprehensive, and authoritative source of single-family policy for lenders, servicers, and other FHA program participants. And the new sections of the Single Family Handbook governing the HECM include this. Section 2B covers FHA policy for the origination through post-closing and endorsement of the HECMs. And then there's Section 3B, and that covers FHA's policy for the servicing of HECM loans and also loss mitigation options to assist those HECM borrowers who may be behind on their HECM mortgage obligations such as property taxes or homeowners insurance. That concludes another episode of HECMWorld Weekly Podcast. Thank you for joining us on our video version. Don't forget, you can find all of our content here at HECMWorld.com, and please share this video with other mortgage professionals. We thank you so much for doing that. And if you're watching on YouTube, be sure to hit that like button. That actually increases our relevance and our search findings on YouTube. So thanks again, and we look forward to having you back next week.